In this questions, we are going to do income statement for a trading business. See the question. The following trial balance was extracted from the book of Said at the year end of his first year of trading, 31st January 2015. A trial balance is given here. So a trial balance. This is the debit side balances, right? This is the debit side balances. Debit side balances, this is credit side balances. Okay, so here capital and premises at cost, equipment at cost, revenues. Revenue is a credit balance account, it's a revenue. Capital is a credit balance account. Then apart from that, discount received is a revenue. Then trade payable is a liability. So all these are the credit balance account. Other than this, everything is assets, expenses and drawings. Okay. Debit side balances. All the credit side balances are liabilities, revenues and capital. This is asset, expenses and drawings. Now additional information given here at 31st January, that is closing. Okay, the inventory was valued at 4,100, that is a closing inventory, and insurance was paid for 14 months to 31st March 2015. So we have to check what is our financial year end first. There is a first procedure we need to check while doing financial statement or any other problem. So here, as per the question, the financial year end is this. See the question. Financial year end is 31st January 2015. That means it is the financial year is starting from 1st January to 31st. It is ending on 31st this January, isn't it? So it is starting from 1st February to 31st January. Okay, this is the financial year, right? So here 1st February 2014 to 31st January 2015. Okay, this is the financial year. So the insurance was paid for 14 months till 31st March. Till 31st March they paid till 31st, because our year end is 31st January, but we are paying till 31st March. So how many months are prepaid here? Apart from January, February as well as March, 2 months is prepaid. Okay, 2 months prepaid, that we need to calculate. 2 months prepaid. 1/3 of the rates related to Said's private flat. Okay, that we have to deduct from the rates. Then during the year end, Said's took goods costing 580 for personal use. No entry have been made during the year. This should be deducted as a drawings. This should be deducted from the purchases of the trading account. Provision for doubtful debts created 2% on trade receivables to be created. Equipment is to be depreciated 20% per annum using 20% per annum on cost. So these are the information given here. So first we will start with the trading section. So the equation for the trading section is gross profit is equal to revenue minus cost of the goods sold, or it is also known as cost of the sales. Okay, see here revenue means sales minus sales return. Okay, revenue means sales minus sales return. Cost of the sales means, or cost of the goods sold means, opening inventory plus net purchases minus closing inventory. So here, what is net purchases? Net purchases means purchases minus purchase return, purchases minus purchase return plus carriage inwards minus goods for own use. So So these are the equation we need to use for finding gross profit. So first we'll start with the revenue. So first of all, you need to find out revenue. So revenue will be credit balance. Okay, so revenue, if there is any sales return, that should be deducted. Since there is no sales return, so we can directly take the take into the question that revenue to the question. So I'm starting with the revenue. So right here, revenue, this is the main area, okay, because the main equation. So I'm taking in the third column 77,100. Okay, then the next equation, revenue minus cost of the sales, isn't it, to calculate gross profit? So less cost of sales, cost of the sales. What is cost of the sales? Opening inventory. So start with the opening inventory. Okay, opening inventory. Opening inventory will be there in your trial balance. Okay, so check the opening inventory. Check if there is any opening inventory available. Since there is no inventories available as per the question, there is no inventories, so you don't need to take it. Okay, if there is opening inventory, you can take it. Here there is no opening inventory, so you can either put 0 or you can omit that one. Okay, the next one is net purchases. As we know, purchases means purchase minus purchase return plus carriage inwards minus goods for on use. See, the goods for on use will be given in your additional information. The fourth adjustment is goods for own use. Okay, during the year ended, said took goods costing 580 for personal drawings. Okay, so that should be deducted. So what is purchases? Net purchases. So purchases is here, purchases is 62,030. If there is purchase return, that should be deducted. Okay, if there is carriage inwards, that should be added. So carriage inward is not there, so directly you can take purchases and deduct the goods for own use. Okay, there is no purchase return, no carriage inwards, so no need to take it. So next is purchases. Purchases that you can do in first column, the working notes. Purchases is 62,030, isn't it? Less goods for own use. Okay, less goods for own use. Okay, that was 580 as per the adjustment. So we'll write the total figure of the purchases here, 61,450. Okay, then so opening inventory plus net purchases, this is net purchases. Now deduct closing inventory, less closing inventory. Closing inventory is there. Closing inventory is always, it will be available in your additional information, 4,100. So deduct that 4,100. Okay, now take the items to the outer column. So it will be, there is no opening inventory, so it's 0. So opening inventory plus net purchases minus closing inventory. So you will get 0 plus 61,450 minus 4,100. So it will be 57,350. Okay, this is called as cost of the sales. Okay, this is called as cost of the sales. Now apply the equation for finding gross profit. Gross profit is equal to revenue. This is the revenue minus cost of the sales. So you will get gross profit as 77,100 minus 57,350. So it will be 19,750, isn't it? This is called as gross profit. Now, so the trading section is over. Okay, this is called as trading section, which is directly related to the production. Okay, now the next part is profit or loss account, right? So what is here, we need to calculate net profit. So net profit is gross profit plus other income. We need to find out the other income, then less other expenses. Okay, this is the calculation. This is the formula for finding net profit, gross profit plus other income. So already we got gross profit as 19,750. So check what are the other income available as per your question. So always remember, revenues and income. Okay, revenue, income, all these items will be there in your credit side. So you can check the credit side. Capital is not a revenue. Okay, that's a capital only. Here it's revenue already taken in the trading section. Okay, it's already taken in the trading section. Then discount received is there. So this is a revenue. This should be taken, and this is a liability. Okay, so only the discount received is available. Okay, discount received, there is no adjustment for discount received, right? So directly you can take add other income, add other income. So what is the other income here? Discount received. Okay, so you write here discount received. So only one item is there, so you can directly take in the outer column. Discount received is 43. Okay, 43. So total you will get 19,000 gross profit plus other income. Okay, 19,793, isn't it? 19,793. Yes. Now we need to take the other expenses. So less other expenses. There is no, it's not mandatory to write this. Okay, I'm just writing for your understanding. So other expenses are, all other expenses are here. Capital is a SOFP item. Okay, this will go to statement of financial position. Premises is also SOFP item. Equipment is also SOFP item. Revenue we already taken. Purchases taken. Wages is a P&L account expenses. Okay, insurance is a P&L account expenses. Advertising is a P&L account expenses. Bad debt is a P&L account expenses. Rates also P&L account expenses. General expenses is a P&L account expenses. Discount received we taken, it's a revenue. Trade receivable means that's a asset, so it's a SOFP item. The trade payable is also liability, it's a SOFP item. Cash drawing also deducted from your capital, so it's a SOFP item. Bank is a asset, it's a SOFP item. Okay, now we have wages. So check is there any adjustment for wages first. See here, wages, we already taken the closing inventory. Okay, closing inventory we taken. Insurance we have adjustments. I think wages there is no adjustment. So directly you can take wages. So wages is 10,140. Okay, so directly take wages here. If there is no adjustment, you can take in the second column. Okay, wages 10,140. Directly I took it. Next we have insurance. I think insurance we have adjustments. So take the insurance amount. So insurance is 2,800. Okay, right. Now insurance was paid for 14 months. So as per our financial year, from 1st February to 31st, it's 12 months, isn't it? So we have 2 more months, because that's why it is 14 months. So we know that the amount is 2,800 for insurance. So 2,800 divided by 14. So you will get each month how much is the insurance. Okay. So 2,800 divided by 14 will be 200 per month. Okay, this is the insurance amount per month. So we have 2 months here, this February and March, because you paid till March. So this February and March, that is 2 months, is prepaid. So that is not related to this year. Okay, so according to our matching principle, we cannot take it. Okay, because that expenses are not related to this year, that is related to the next financial year. So it should be deducted from the insurance expenses. Okay, so 200 into 2, 400 is prepaid. Okay, this is prepaid expense. So now take here, you can do in bracket or the first column, 2,800 minus 400. So it will be 2,400. Okay, so this is prepaid expenses. This 400, this will comes in your SOFP as a current asset. Okay, because it's for the next year. Next we can take advertising. Okay, advertising expenses. There is no adjustment for advertising, so directly you can take the amount. Advertising is 1120. 1120. Okay, the next one is bad debts. Bad debts also you can take directly. Bad debts. Bad debt is 90, isn't it? So 90 also you can take directly. 90. Then so this we taken. The next one is rates. 2160 rates. We have one adjustment. 1/3 of the rates related to the sales private flight. So that rates are not related to the business. Okay, so we'll check how much is 1/3. Rate is how much? 2160. 2160 into 1 by 3. How much it is? Just calculate. 2160 into 1 by 3. So that is 720. 720 is not related to the rates. So that should be deducted from the rates. So I'm writing rates here. Rates. I'm deducting that. 2160 minus 720. Okay, so you will get 1440. Okay. Then we have general expenses, right? That I am taking here. General expenses. General expenses. There is no adjustment. If check it if there is any adjustment for general expenses. No, right? This we taken. This we taken. Now we have only 2 adjustments. So general expenses you can directly take. 151. How much is general expenses? General expenses is this one, right? 151. Yes. So 151 I'm taking here. 151. Now next part is provision for doubtful debts to be created, right? A provision for doubtful debts on 2% on trade receivable should be created. That is a new provision. Okay, new provision should be created. So here it is on trade receivable. Okay, it is on trade receivable. Now check the trade receivable balance, how much it is. Trade receivable is an asset, so it's a debit balance 6500. So you have to find out 6500 into 2%. 6500 into 2 divided by 100 will be 130. Okay, so that 130 you should take it as a expense here. 130. So right here provision for doubtful debt 130. 130 you got because it's 2% of your trade receivable. Okay, 6500. Okay. Apart from this we have one more adjustments, that is the provision is taken. Equipment is to be depreciated 20% on cost. So here equipment, so that is depreciation is an expense, so write depreciation on equipment. Okay, equipment. So directly, no, there is no methods given, so we are assuming it's a straight line method, and you directly the 20% you can calculate from the equipment. So equipment at the at cost is 9300. So equipment at cost means calculation will be 9300 into 20%. So it will be 930 plus 930, 1860. 1860. Okay, now take all the expenses together, total all the expenses and post here. So you will get 17,331. Okay, all these expenses together. Now apply the equation. Gross profit plus other income. We got the final amount here. Now deduct the expenses 17,331. Then you will get net profit as 2462. Okay, so this is called as profit of the year. profit for the year. It's also known as net profit. Okay, net profit. So this is the total calculations for income statement to find out the net profit, gross profit, everything. So take the equations, understand the financial year. So here, if there is adjustments, I'll give you a small note here. If there is adjustments like accrued expenses in income statement, what you should do? Accrued expenses or accrued income, prepaid expenses and prepaid income. If it is accrued expenses, all the accrued should be added in the income statement. Okay, accrued should be added and prepaid should be deducted. So keep this in your mind. Accrued or outstanding, it's also known as outstanding. Okay, outstanding expenses or income added in the income statement. Prepaid expenses or prepaid income deduct from the income statement. Okay, so this is only for the income statement. So this is the result for the income statement. Okay, thank you.